What's going on, guys? It's John Dion here, and today I want to talk to you about one of my biggest pet hates when it comes to the property investment game. I love talking to property investors. It's my absolute passion, but the one thing that annoys me the most is the first question we all want to know, which is how many properties they own. It's completely understandable. Those are the headlines that sell news articles and gets people listening to your podcast. 10 properties in 10 years, 20 properties under 30. And although it's a great accomplishment for that individual, even they may be hot on the case for the number of properties rather than investing in good assets themselves. I think the way that this gets reported doesn't help much either. Like these statistics released from CoreLogic in 2018, stating that 18% of investors own 2 properties, 5.5% of investors own 3 properties, 2% of investors have 4 properties, 0.8% of investors own 5 properties, and 0.9% of investors own 6 or more investment properties. If you have the competitive mindset that I do, I instantly want to be in that top category, or at least in the top 5% with those 3 or more investment properties. But I don't think the way that this data is represented is correctly correlated with the performance of any one individual investor. Take someone with 6 properties all worth $250,000. I've met plenty of people who have bought properties in this price range. It's not unheard of, and it's probably more common than you think it is. Well, their total portfolio would be worth $1.5 million. Now, let's take another investor with 2 properties valued at $750,000 each. Their total property value would also be $1.5 million. So although these 2 investors could be categorized completely separately based on the previous example, in another light they're on the exact same level. I guess this brings in the whole cash flow versus capital growth discussion, where generally cheaper properties have a higher rental yield and typically pay more of their running costs off, and therefore cost less to hold. And on the more expensive property side, they are typically in areas or types of properties that have historically been driven up by demand, hence why they're more expensive, and have been said to have a better, stronger capital growth, although no one has a crystal ball. This typically comes at a cost though. They generally have a lower rental yield, and so investors have to put more into the property annually due to those higher holding costs. If you want my opinion on this topic, you can watch my previous video here. Also, if you're loving this content, don't forget to smash that like button. In the specific example before though, I would much rather deal with only 2 tenants that have strong incomes and could afford to live in those more expensive properties, than 6 tenants that could all up and go at once. And if this happened in both scenarios, I would rather only find 2 new tenants than go through the whole tenant selection process with 6 individual properties. It's also critical to note here that we aren't buying the Australian property market. In fact, no such thing even exists. There's thousands of submarkets within Australia, and they all perform differently at different times. So although you may have 3 years of strong capital growth initially, the next 7 years may be very stagnant. This is why property commentators bang on about a minimum 10-year approach, which essentially means we can't accurately assess the growth performance of an asset until they've gone through a full growth cycle, which typically takes 7 to 10 years. So our second contestant for the measure of the performance of a property investor is their total portfolio value. And although this does have some good indication, it can also bring in some bias from investors who have done successfully outside of property, such as in business or shares, and dumped a whole lump sum of cash into their investments. So the total portfolio value is no good. Well, what about equity? Well, that's kind of the same thing really. Equity is just how much of the portfolio that we own. And again, this can be diluted by the injection of a large amount of capital. Same for LVR. I used to drop to my knees and bow before younger investors that told me they had an LVR lower than 50%. What an achievement. But really, how much capital have they put in to begin with? These things we will never know, whether they got a lump sum from an inheritance or have built in a family portfolio. And unfortunately, a lot of wealth advisors and property coaches and even buyer's agents sell their services to their clients based on this success. But if they were that successful, would they really still be working? I guess that's up for you to judge. Acknowledge if they have your best interest at heart rather than just trying to make a sale. So what can we use to measure an investor's performance? Well, I think we've touched on one part of the formula, being total portfolio equity, which if you recall is just the total amount of the portfolio that we actually own. So in that $1.5 million example before, say we still owed the bank $1 million in debt, then our total equity would be $500,000. On the other side to this equation, we would need the total amount of capital invested, which is essentially how much that we've put into the investments compared to how much we've gotten out. The third element to consider is the total cash flow of the portfolio. How much in additional payments have we had to put in towards our properties? Or in a positive cash flow scenario, how much has the properties paid us as an investor over that holding period? So to make a fair assumption on a leaderboard, we would need the total capital invested, and this would include deposit amounts, stamp duty, professional costs. We'd need all of the ins and outgoings such as interest repayments, property management fees, repair costs, and rental income. And then finally, we need an accurate property valuation and the total outstanding debt amount. But really, who's going to provide this much personal information just so that they can be reported on for a more accurate reading of the performance of an individual investor? Not many. So this is why they come up with these uncorrelated categories that, in my opinion, just encourage the wrong investing behavior. At the end of the day, what I failed to mention at the start of this video is that only 7.9% of Australians are property investors. So even if you have one investment property, that's an outstanding achievement, and you should be proud of yourself rather than comparing your portfolio to these news headlines that are only written to sell an article. If you've got 2 investment properties and you do the math, that means that you're one of the 1.42% of Australians that have achieved the same outcome. You've set yourself up financially for the rest of your life and have accomplished a huge milestone. And that's why it's okay to be in the bottom 95%. I want to know what you guys think would be the best measure for categorizing the performance of a property investor. Leave it down in the comment section below. As always, seek your own professional financial, legal, taxation, and property investing advice for your current situation. These videos are just my opinion and are general in nature and should never be considered as personal advice. If you're keen for more content, make sure you subscribe and smash the notification bell so you don't miss a video. And until next time, happy house hunting.